Zoomed. So this is a free video. All the materials in the video will be below the video on Substack, so you can read those also, or check them out after. Yeah. So this video is about why Zoomed is back in my portfolio, kind of going through why I think it's a great risk reward right now. And I'm not gonna go over the whole business model. I'm kind of assuming you know what the company does. I mean, I linked the investor presentation here, so you can check that out in the materials. So, but first, I'm gonna go over some context about my history with the stock. So first I got into the stock around here last May, and then it went up, and then it started going down because of this Q3 result. I sold it immediately when they released the Q3, and I got like a double, but after that the stock kept going down, and now it's at 84 cents, closed on Friday, and now I think it's quite a nice dip. So based on the Friday's closing valuation here, we have price to earnings of around 3.5 and EV to earnings of around 2.5. So it's quite cheap on the multiple, and this is a company that basically it has some short-term problems, but even mid-term I think they are gonna be back on track, likely, and growing, long-term growing. So I don't think this is gonna last, this valuation. So I tweeted out initially at 94 cents. So now it's 84 cents, and now I think obviously it's even better. I added some on Friday, and yeah. So why did I sell? Basically, they released this quarter. The revenue fell from almost 20 to 16 million, and this was because two clients kind of had a problem or transition that they stopped spending. So that kind of, I thought that kind of is gonna halt the momentum on the stock for a while, and it's an opportunity cost, and I really like some other stocks at the time, so I decided to sell the stock. So why did I buy back? I mean, the biggest reason is that the valuation just got cheaper. The stock is at a lower price, and so valuation is it's almost 50% cheaper than when I sold. And now, and the chairman did an interview recently that gave more clarity on the reasons behind the Q4 decline, and basically I think we have more clarity now on the path back to growth. The time passed, so I think the time to the rebound of the stock is shorter from here. So basically the short pitch is that I think they have a high probability path back to gaining that momentum that they started gaining in 2026, when they went from 15, 18, almost 20, and the earnings were going through the roof. I mean, the earnings are still strong. The profitability is still strong at 16 million. So that's an important thing to point out. But I think they have a high probability to get back in, let's say, in the second half of 2026 to this Q1, Q3 path to back to growth, right? And if that happens, I think the stock is gonna 2 to 3x from this level before year end, maybe even more. And I think it also has limited downside in case it doesn't work out, because the company is quite profitable at even lower levels, and the valuation is so low, and the cash position is getting quite high. So it has somewhat of a margin of safety. Of course, it's not like a bulletproof margin of safety. It's gonna go down if certain things happen. But we will get to that. I mean, I will get to that in this video. There was also, they talked about how there was this Euro Cup football, soccer for Americans in Q3 2026, and that's why the year-over-year decrease. But the year-over decrease was not the point that caused the stock to go down. It was the quarter-over-quarter decrease. Yeah, so, but on the quarter-over-quarter decrease, the chairman probably should have it like this, more like, yeah, I should have it like this. If you didn't see these texts, now you can see the texts, right? Okay. So I'm gonna summarize all of this here. So this was mid-February, new interview. So basically what happened is two large clients halted marketing because they changed their MMPs, mobile management platforms. I already forgot what that is, but it doesn't really matter. Supposedly they remain clients, and they already did this change in Q4, and they are supposedly back to business with those clients. But the interviewer asked when they're gonna be back to full speed with those clients, basically back to the previous spending levels, and the chairman said they cannot disclose it. Although in the Q3, now this is Q3 earnings call, they didn't talk about the MMP in the Q3 earnings call. They just said that the two of the largest clients are making adaptations and going through a transition that typically takes after transition it would scale up within a few months. Yeah, so they presented it a bit differently in the Q3 call, but if we assume these are the same clients, I do assume that. If that's the case, I guess we could assume few months. So maybe Q2, maybe Q3 they get back. I would say that's a very positive outcome if they can get back in that time. Now this change in the mobile management platform, they say it's very rare, never happened to them before, and that the two clients did it at the same time. It was a massive coincidence, and they didn't know each other. And other clients that were using the same MMP didn't change. So it was just a coincidence that was not their fault that caused this situation. Right, so one kind of risk we have here is that, and I think the stock is pricing some of this in, but you never really know what exactly the stock price is in beforehand. This is what I have learned. But we don't know whether, because if they stopped marketing, they stopped spending in Q3, maybe they stopped in mid Q3, maybe at the end of Q3. We don't know the details on that. So Q4 could take a bigger hit from this effect. although they have a better seasonality in Q4 because of Christmas. But still, this is something that's obviously worrying the market somewhat, but they're saying they're back to business now. So Q1 we should also already have some of that revenue back, but not everything. Now he says in the same interview, he says short-term expectation is that the company is riding like crazy, still generating cash and showing good numbers, and I feel that it's stable. So I guess that's kind of a like riding like crazy and stable. It's not exactly the same thing, but I guess what I would decipher from that, I mean, good numbers, generating cash. I mean, they considered the Q3 numbers good numbers, and so maybe I would expect short term, so Q1 may be similar to Q3 or something like this. Which wouldn't be the worst case scenario. Because I think if there was strong revenue growth short term, I think he would have said that. And in an interview before Q3, before the disappointing Q3, the chairman was talking in a similar way, like not talking about growth, but talking about like how strong their margins are or whatever. So, maybe conservatively, Q4 to Q1, maybe they make like 14, maybe Q4, 14 million maybe Q4, and 16 million maybe Q1, maybe something like that. And then after that, I think we have quite a strong case for getting back on track in Q2 maybe, but especially in Q3. And because of, for example, the World Cup. And they had a significant impact. I mean, they let us understand from the Euro World Cup, and now we have the World Cup. So that is when all the countries play football against each other, or soccer, for Americans, and it's very popular. So yeah, and they also announced this partnership with this betting company in October, and they are rolling it out in coming months. They said on November, so I mean they should be rolling it out now, and they said they expect meaningful contribution already in 2026, and they said that their clients are already securing budgets for the World Cup. So now they are better positioned to take advantage of the World Cup, and it's bigger than the Euro Cup. So that should start showing results, some in Q2, but most in Q3, because it starts in June, but it ends in July, which is Q3, and obviously July has all the biggest games, the finals with the most marketing. And they also said the Euro Cup, it took place around the same time, and the company said that they recognize most of that revenue in Q3. And there was also Q1, there was the Winter Olympics and the Super Bowl. So there's a small tailwind from there also. in Q1. But they haven't talked about those, and those are not nearly as big as the World Cup, so I wouldn't expect anything too big from that, but maybe a small tailwind. Also in the Q3 call they released that they added 10 more new clients that, based on the typical revenue ramp-up time, they expect to see this impact from these wins in 2026. So that's also a tailwind for this year. Those two clients that stopped spending, they really kind of overshadowed a lot of this stuff. They also said that their revenues doubled from outside the top 10 year over year. But they basically still have over 70% of the revenues from the top 5 customers, so they're still very concentrated, which obviously presents these risks that happened in Q3, right? So, okay, let's see the bear case first. It's the quote. I don't remember who said that, but you take care of the downside, and then you have just upside, right? So let's take care of the downside. So these are some of the risks, basically. So first, Q4 shows that the impact of 2 large clients was the impact was more significant than Q3 showed, right? And that may that's a risk. And another risk that they return to previous spending levels is slow, or they just don't, for some reason they don't return to those levels. And then there's just the general client concentration risk that we talked about. So basically that's what happened. That was client concentration risk showing in Q3, and something like that can obviously happen again. Now there is the Iran war going. They don't have a lot of risk from in terms of having revenue from the region, but the big risks is that, you all know about this stuff by now, like what the implications of if the Hormuz stays closed, there's probably gonna be like a recession, and that would cause marketing spending to go down, which would be very bad for Zoomed. Although in that scenario a lot of other stocks would fall as well, and Zoomed has a better margin of safety than most stocks, but the stock would definitely fall. Now another risk, this is, I think, is a pretty low risk, but it's not helping them that they are headquartered in Tel Aviv in Israel, right? So what if they get hit by like a missile, something like a missile? Now it's a very low probability, but if it happens, it's a cloud. I'm sure they have all their stuff in the cloud, and they have 6 offices across the globe, and they can do remote work. But these are just kind of stuff that I don't know exactly what would happen. But I assume they have, like, these Israeli tech companies have prepared for this type of scenario. So I doubt that they would get that their business would, they couldn't deliver to their customers or something. But they supposedly have a lot of their R&D, like their main R&D there, and obviously the main team. So it is a small risk, but I would say the main risk is the Hormuz. The main risk is the Hormuz, and that these 2 large clients come back slow. And so I've just put here, like, let's say some combination of these risk materializes. So for example, if the revenue drops to 12 million per quarter, despite the new clients, despite these sporting events, I mean, even in that situation, the company would still make good money, annualized net income of 8.54 million, and that would still imply a current, like based on the current valuation, that would be 7.1 price to earnings, what is that, P to E, and EV to earnings of 5, which would obviously go even lower as the cash piles up after Q3. But even still, even with having decent earnings at even lower spending levels, the stock would definitely drop, but like maybe 40 to 60% from the current price, which I would say that's not that bad, and that could be even overshooting it, because let's say the stock drops 50% from here. That would imply around 30 million USD market cap. Now the cash was like over 18 million in Q3. Now it's definitely over 20 million. So the EV would be under 10 million and the cash would be still piling up. I mean, the EV to earnings would be like 1 at that valuation if it would drop 50%. So, of course, there could be a worse situation than 12 million per quarter. But I would say that's like a bear case that I can see as a decent probability. If, some of these things happen, like with the hormones and stuff like that, or the clients. But still, like, that's very limited downside, and I would say, and that shows that their strong margins and the cash position, it protects the downside somewhat. And so basically, okay, so here's the bull case. Now we've basically gone through the bull case, but the bull case is to get back to that 2025 growth trajectory. So they were in Q2 2025, the annualized net income was already like 24 million annualized. So if they get back to that and start growing from there, let's say they get to that 25-30 million, you put 10 times PE on that, price to earnings on that, and that's 260 to 300 million market cap, and that would be 4 to 5x stock price from the current price. And I would say that's what I like about this risk reward so much. That's just such a low, so little needs to happen for that, in my opinion. Like, we just need to not have like a global recession, and then for the company to just get back to that trajectory, to get those clients back ramped up, get the new clients back, and they are back to the trajectory, and they are back to this kind of, and what also backs this valuation expectation. I mean, it's not just that 10 PE is so low or something, like it's gonna have to go there, but and I would say it is low for a growing company, but I wouldn't expect this stock to get to 20x PE or 30x PE because of their client concentration and because it's small cap ad tech. Like, not all tech is valued the same, like, because it's not like recurring revenue because it's cyclical with the ad spending. It doesn't get the same. It doesn't get like those crazy valuations. But 10 times per price to earnings, that's very achievable. That's very low ball. And it was already in 2025. It was already going there. It was already going to that price, into that market cap, 250 to 300 million. The stock was already headed there. The peak market cap was around 190 million. And if they would have, and then they got hit with the Q3 result, halted the momentum, and now they are at 60 million. So this is this is momentum. Like momentum starts going the other way, and you have a massive difference in valuation. Even though the change in the earnings was not that significant, it was not that big, right? So now I'm just kind of positioning now when they have no momentum, but we have I think a solid path to get there. And then waiting for it to come back and to get to around that kind of valuation at 10 price to earnings. After that, I think I would be looking for exit, as when it gets to 300 million or something. It's just not as asymmetric anymore, and then you have the risk of you can see what happened in 2025. So you have like one client or one big client, two big clients for some reason stopping spending, and the stock can go down a lot. So I would say like when it gets to that valuation, the risk reward starts getting worse. I would be looking at exits at those prices. But at 60 million market cap, at around 40 million enterprise value, I don't know. I think this is very attractive risk reward. So that was it. Yes, and subscribe to the
Sekin Alpha Premium is the only almost Mongolian approved paid investment research service. Friteups on stocks. Comment sections. Detailed financials with the ability to change currencies. Valuations. Dividend history. Earnings estimates. Compare pairs. Easily accessible SEC filings. Earnings call transcripts. NEVs. Stock screener. I choose Argentina. Market data. Get $30 off with my affiliate link. It's only $269
for the first year.
It's nothing. There is also 7-day free trial.